Broadcast is now starting. All attendees are in listen-only mode.
Welcome, everyone. Good afternoon. My name is Megan Cox, and I'm the Marketing Events Manager at Kuranos. Thanks so much for joining us for today's webinar. It's go time for commercial banking. Are you ready? As the industry's leading provider of data analytics and technologies, we are here to help you better attract, retain, and grow more profitable customer relationships for your financial institutions. If you have any questions during the presentation, please type them into the question box in your GoToWebinar control panel. The webinar is being recorded, and we will send the recording and the deck to you via email post-webinar. Okay, Margarita, let's begin.
Thank you. All right, so first, thank you everyone for joining. Before we dig in, I wanted to share a quote because I think this really sums up why we're focusing today on driving strategic growth in commercial banking. The challenges of the last few years are absolutely still with us, and they're really forcing banks to fundamentally think differently about how and where you're going to find growth. So we recognize that the things that got us here are not going to be the same things that get you to your next stage. For those I haven't met, I run our commercial banking line of business, took it over from Peter Serene middle of last year. I come from a top 25 bank where I ran the West Region P&L for everything related to commercial deposits and treasury management. My team covered 6 states and 2 specialty businesses. And throughout my tenure, we leveraged Kuranos data on a regular basis so that we could materially outperform industry benchmarks through the rate upcycle. So I know the organization well and have sat in or near your seat in the past. I'm joined, of course, by Peter Serene, our Managing Director and Head of Advisory Practice, and then also Bob Warnock, another Managing Director. All right, as Megan shared, many of you do know us well, and we are the leading provider of industry benchmarks, data, and analytics to commercial banks. So our clients are consistently leveraging our tools and expertise really to improve their business performance, and we're really going to discuss that in the slides going forward. All right. Before we dig into growth strategies, we would be remiss if we didn't have a conversation quickly about the industry context through our data. So an important thing to recognize, no 2 banks on this call are the same. We have different sizes, geographies, histories, and growth strategies, but all of us are united by being influenced by Fed rates and that consistent need for a healthy foundation of deposit balances to grow our business. So we are going to start with a quick view of what you all anticipate for 2025, and then also how we are seeing the industry faring so far through the new rate cycle and managing deposits and the cost. That'll give us that view into the context for growth in 2025. So we will start with a couple of quick polls. So our 2 questions, Megan can go ahead and open up the poll. What is your 2025 outlook for average growth in the commercial deposit balances across the industry? So how much do we think the industry is going to grow? All right, seeing some good responses coming in. Fairly similar to what we saw yesterday. All right, so as you can see, bullish expectations for the industry. So up more than 3%, but less than 7%. That creates an environment of high expectations for growth, which is why all of you are interested in what should the strategy be. Any comments, Peter or Bob, in terms of what we see for those results?
No, this is roughly in line with what we've expected. Interestingly, it is. If I think about this, it's a little bit of a barbell between the half that are expecting, really strong growth back to sort of normal historical levels in the good times, and those that are, broadly, I'm reading the 3 next ones around flat. that's kind of where we've been for the last couple of years. So, so some people, half are seeing more of the same, half are seeing a real pivot to a different operating environment.
All right, let's do the second poll. So this is focused more on what are your bank's forecasted growth. So as you think about, top of house has said commercial deposit growth is going to be this. All right, some good responses. We're almost there. Okay. Look at that disconnect. And many of you are going to feel some pressure as you're going to live through a potential disconnect between top of house expectations and what all of you are expecting the market to actually do, which means there's going to be a lot of trading of market share potentially with expectations that you outperform. Peter, what other comments would you have around these results?
Yeah, look, I sort of joke whenever we ask this set of questions, as we do periodically, it's kind of the party trick, because most of the time you end up with growth goals that are above the outlook for the total market. You know, that's not surprising to us, but as Margarita said, you know, that really points to that points to a broad expectation of share take. That can't be the case for everyone. So the natural result of that is heightened competition. And look, that's right in the fairway of kind of what our outlook is for 2025. So, you know, I think this is validating a lot of what we would expect in that regard.
Great, thank you. So why don't you take us through, you know, how have we done so far in managing through this initial phase of some rate decline?
Yeah, sure. So what we're showing here on the page is betas so far for the industry. These are average betas across business segments through the first 100 basis points of cuts. You know, really strong performance out of the gate from the more rate sensitive segments, commercial, wealth, direct bank. The sort of flip side of that is looking at consumer and small business, where it's been much slower going. And, you know, that's a real structural headwind because you know, if you look at those books, there's a much higher percentage of balances that are either in non-interest bearing products or priced very near zero in back book. There's nowhere to go down. And in fact, some of that money may wake up and seek higher rates, even if we're off of the highest levels that we saw sort of at the peak of the plateau at the top of the last cycle. So you know, that points to that points to a very dynamic market. If you think about growth, there's still a lot of repricing risk in those other segments. If you go and try and grow in businesses that have large back books, so that will shift you know, some of the onus for growth into the businesses where you can be a little bit more surgical, a little bit more targeted with the offers. Businesses like commercial and wealth, that's going to play into this narrative about increased competition. The other thing to note here is, you know, if you look at the portfolio rates versus the acquisition rates, we sometimes hear, oh, commercial balances are expensive. And sure, you know, overall, you know, the rates are higher, they're meaningfully higher than consumer or small business. But if you look at the actual acquisition cost, the rate at which those balances are turning, they're much closer. So from a growth standpoint, the dollars in play, commercial is right in the fairway. And these are just nominal acquisition costs. These don't even factor in back book cannibalization. So if you take a marginal cost of funds lens on this, maybe much more expensive to acquire in consumer. What that points to is, you know, we're going to be probably looking at commercial as a key driver of growth across the industry. But at the same time, there's a lot of revenue increase priced into bank stocks right now, and that probably can't all come from the top line. We're going to have to manage expense on the book overall, really differentiating between what we're paying to acquire and what we're paying to retain. And so there's a real pricing component to how we win or lose within this market. Those are sort of my remarks on it. Bob, Margarita, anything you would add there?
The only thing I'll add is just for those institutions that are smaller or that do have small business under their purview, we are taking a lot of interest from your treasury counterparts within the banks in terms of what is going on with small business. Why is it so cheap relative to even retail? How long can this paradigm last? What should we be doing differently in terms of optimizing commercial while growing our small business franchise to offset some of that higher interest expense? Now, this ignores the marginal cost of funds paradigm, but it is a question that we are getting, especially as the portfolio and acquisition rates in retail continue to percolate above small business.
Makes sense. Why don't we go ahead and touch on a little bit of that effect of the competition for deposits, and then we'll go into strategies for growth.
Yeah. So look, we touched on the poll, right? The majority of this group expects that we're going to be up. Half of this group thinks we're going to be up 3 to 7% as a market. That's reflective of where we were in sort of the best years over the last decade and a half. It's not where we've been recently. So the market overall has been flat. That's been a combination of some technical factors, quantitative tightening, essentially some remixing of dollars off bank balance sheets to fund the Fed balance sheet drawdown. But unless something really changes in the market, behaviorally or macroeconomically, the base case is that we're still in a pretty low growth environment. That said, there's a clear imperative to grow. It's priced into the stock. And if you look at loan to deposit ratios, they're much closer to normal levels. If you look at the Fed reverse repo facility, which is kind of the liquidity safety valve for the industry, that's down. Your shock absorber for the industry, that's down 95% from peak of over 2 trillion to about 50 billion today. So the excess has largely gotten flushed out of the industry. So marginal growth on the asset side of the balance sheet requires marginal raw material from the deposit. So that's really underlying our thesis that we do expect a very active market as a lot of banks try and hit those sort of mid-single-digit growth targets in a pool that may or may not be up. A lot of complex factors that'll drive that, but it's no sure thing that we're going to have a sort of rising tide of deposits that's going to lift all boats.
All right. So on that, how do you become a boat that lifts higher than the others? In 2025, what we're seeing is 4 priority areas that banks are focused on for growth. So these are, where are you focusing your time, energy, and resources to capture growth? Number 1, clearly a focus on mix and total relationship value. So that pulling back from CRE or a tempered interest in CRE because it doesn't bring those full relationships, and the need to find areas where you can get the lower cost operating balances alongside the fee revenue that gets you an improved net interest margin. All of that comes from needing to retool your portfolios and make sure that you're in a position to have feet on the street that know how to capture those new types of relationships. We'll go into that one more. Differentiating to win. This continues to be an area of focus, especially over the last few years when lending was a bit more tempered. Banks were really focused on bringing out differentiated offerings that could make them more attractive to specialty industry sectors or stand apart for a digital experience for clients so that they could win an outsized share. Continued pricing discipline, and this is very much agnostic to the rate environment. So thinking back to that acquisition, those acquisition numbers, having a lot of discipline in how you take advantage of any future rate cuts, but then also as you're acquiring new relationships, are you effectively using pricing insights to temper the enthusiasm potentially in your front line to sort of win at all costs? That's not going to be looked at favorably anymore. And then lastly, of course, it all comes down to who do you have out in the field. If your front line can evolve to take advantage of the new strategic focus and do so in a way that manages and maximizes business profitability, then you'll be in the winning category. If your sales teams don't understand how to make this shift or use tools effectively, then your path is going to be slower and it's going to be much harder to take the level of market share that you're looking for. All right, let's talk a little bit more about mix. I'm going to pass this back to Peter to talk a little bit about obviously some of the challenges we have and the motivations to make that shift.
Yeah, sure. So a couple of things have changed as we think about taking share from the kind of the last really bullish upcycle in commercial. The first is on the competitive landscape. Private credit has moved from kind of a marginal player to a real factor in the middle market space. In particular, it's sort of 20%. So that requires sort of the traditional playbook of we're going to leverage the customer's lending need and our ability to extend balance sheet, customer's borrowing need and our ability to extend balance sheet as the wedge into the relationship, and then we're going to pull through the operating accounts and the payments. That's no longer sort of the going to work for 1 out of 5 prospects you're in front of in the middle market space. So that really requires a repositioning to stay flat, much less to grow, right? The second big shift is in terms of how you make money on the relationships. From the start of the cycle to now, we've gone from roughly a 50-50 mix in non-interest bearing versus interest bearing deposits to a 70-30 mix interest bearing to non-interest bearing. We haven't been here before, right? Because the last cycle was too short and too shallow for this to really play out. And the cycle before that, we had Reg Q. So we had a different product set, a different operating environment. This is kind of new ground in a lot of respects. And even as rates have come back a little bit, we certainly don't have an expectation that this is going to revert to the levels we were accustomed to, and we haven't seen that in the data. If you think about the implication of this on that 20% of deposits, you are giving up probably 200 to 300 basis points on total relationship return on those deposits when you factor what you're paying in interest rates, offset by some fees that you're collecting versus offsetting with ECRs. But those ECR rates and those interest rates got so disconnected that it's really difficult, unless you had a very strong falling rate cycle, which is not in the consensus forecast models anymore. It's really tricky to recover that. So what you need is you need really sharp pricing, total relationship view, and you need to, as part of that, have the volumes and get paid for the volumes on the payment side. So those are all sort of factors that require us to compete a little bit differently than we had before. Next page. So what does that look like? How do you do that? There are a couple of approaches. One is getting really sharp on which segments of the market we're playing in terms of small businesses, middle market companies, and then up to the larger corporate institutional clients. The way these companies construct their balance sheets differs. Their amount of net leverage differs. Their access to different funding markets differs. Their payments complexity differs, and your pricing power differs. So being really realistic about where we're going to win and how we're going to win from a customer size standpoint is the first step. The second is vertical specialization. This is something we've talked about for a while, and certainly there's sort of deposit-rich industry plays. That's not sort of new ground, although many banks are still focused there. But what I would say is sort of a little bit of an updated definition of a vertical strategy is really built around expertise, both on the credit side and the payment side. There are verticals that have, from a credit perspective, it's the ability to expand the buy box and get to yes and compete a little bit more with private credit in some of those spaces. On the payments and liquidity side, it's the ability to have a real advisory discussion with those customers in an environment where cash conversion cycle optimization is much more valuable than it was in a low rate environment. Especially if we stay in the sort of higher for longer, we're going to get the 2 cuts, not the 6 cuts that we'd hoped for this year. And maybe in some outside scenarios, we don't get any cuts. There's going to be real benefit in being able to add value to how companies optimize their cash conversion in a way that always has been sort of part of the talk track, but just hasn't been worth as much when money was free. And then the last piece, as Margarita touched on, we had sort of expressed this in terms of C&I. The other language that I like to use around this is where's the payments complexity, right? Where do we have volumes, tricky things to solve? Those high volumes and tricky payments needs allow us to add value through a payments relationship channel. They allow us to monetize that through fees. And those are the things that truly make the deposit sticky as well, and provide increased liquidity value to the bank. So those are the three key factors.
The only thing I would add on the segmentation side is just be careful that you're not using segmentation as a way to just rearrange the deck chairs. It has to actually help you go to market more effectively in your sweet spot of where you think you can win. So I would just really encourage, as segmentation discussions are underway, really making sure it aligns to the growth strategy and is a way to marshal the right resources around the areas that you think you can win. Bob, would you add anything before we keep going? Okay.
All right.
Go ahead, Peter.
So we've talked about this. Let's put some numbers around it. What we're looking at here is DDA deposits relative to C&I balance sheet. It makes a really big difference if we do all these things, get the core operating accounts and get them in the right places where there's a lot of frictional cash. You can see the amount of difference between sort of bottom quartile, median, and top quartile performers in terms of their ability to translate the balance sheet that they're extending into bringing in deposits. Certainly it's a little bit, probably a little bit easier, maybe not from a risky credit perspective, but from a demand perspective, it's a little bit easier to lend into highly leveraged customers. But if you do the hard yards with some of the lower net borrower customers and really pull through that whole relationship, you see that there are businesses that provide a lot more funding value to the overall institution from the way they're using their commercial balance sheet. What drives that? Well, you get the right clients in the door, get the right go-to-market and cross-sell, penetrate the relationships, and then use our pricing effectively. Those are the first sort of big needle movers. The next one is really around you get what you pay for. We've done a lot of work with banks over the last several years on refining incentives, both for the bankers and the treasury officers, to move from sort of loan focus to paying for deposits to paying for the right deposits and the operating volumes that underpin those. So that's really important. And then finally, you'd be remiss not to talk about the product suite a little bit. There have been a lot of regulatory changes. There've been technological changes. There's been a lot of emphasis on innovation in products for the lower end of commercial, upper end of business banking. So this has been a relatively dynamic area in the last couple of years relative to where it's been historically. And so it's a good opportunity to make sure that we do have the right shelf of products in the market and the right people who really know how to sell those products and get the right product in the right hand of the right client.
The only thing I will caveat is, again, the far right-hand side of the bar charts are larger nationals, super regionals on average. The majority of the mid-tiers do pay in that median to bottom quartile and around those two boundaries. There is no owner-occupied CRE in our definition of C&I, and this is truly excluding all business banking deposits, would obviously skew more towards liquidity than leverage. So you are looking at a pure representation of middle market C&I for the average institution.
Yeah, and that's a fair call out. And we really, when we talk with our clients about helping them plot on these different ratios, the more important message is simply understanding where you stand today and then saying, where do you want to be and how do you think you'll get there? So this is looking at a similar ratio in terms of the gross treasury management fees to a CNI loans outstanding, and saying, what is the value of moving up this stack? And we typically see an incremental 800,000 in annual gross TM fees for every 1 billion in CNI loans outstanding. That's meaningful, and it's similar strategies to get those in as what Peter described for the deposits. Are we winning the right relationships? Are we optimizing the cross-selling of our back book, who perhaps hasn't in the past been expected to bring the operating relationship and all of the valuable fee-based revenue as well. And then there is, of course, how mature is your treasury management product suite? Do you have the right valuable products in place? Are you pricing them correctly? Do you even know what pricing them correctly looks like? That's where external benchmarks can be really important. And then are you making that critical decision around balancing the relationship needs and the value of the relationship with the profitability for the bank? So you always want to be careful that those most valuable primacy relationships haven't become the relationships where the balance of power has tipped so far in favor of the client that they're basically negotiating concessions across every lever of the relationship, and you're losing all of your profitability. So again, thinking about mix, long-term shifts, this is an important part of the value lever of that, and it's really about what is your starting point, where would you like to be? All right, so the next area, certainly, this is very much tied to it, but that differentiating to win. As we think about what does it take now to compete, that treasury management space offers an area that is for banks evolving the fastest in many ways. So you continue to have pressure from really large banks with deep pockets that can innovate faster than some of the mid-tiers. You have platform players in the ERP and accounting systems who themselves want to capture that fee-rich payments activity, and they want to own that client interaction as far in as they can, taking away the need to even interact with the bank platform. And then you have the processors and the fintechs who as well become a tremendous source, not just of differentiation and innovation, but they're setting a new bar for what does it look like to have payments experiences for not just consumers, but also for companies. So against all of this backdrop of innovation, that's why we see it as so important to you're not trying to compete against those deeper pockets. What you're trying to do is say, where do I think I can differentiate and win in my target markets and verticals? Do I have strengths in my existing portfolio, in the expertise, foundation of expertise in my teams, that I can expand on that and make targeted investments that ensure that I continue to compete and can punch above my weight?
Again, do not overestimate simplistic changes to product. Simplification of product, evolution of bundles, even for some of the lower tier, mid tiers, there's low-hanging fruit to be had without much complexity.
Agreed. All right, so then as we look at, so those are a couple of the big growth factors to consider. So how do you differentiate to win? How do you focus on the right mix? The other piece really, because growth and new client acquisition, as we know, takes time, right? That is the long game. In the meantime, how you manage your existing portfolio continues to be critically important. And what we saw through the rate up cycle is a very different varying levels of discipline that we saw with clients in how they approached the pricing. So what we're looking at on the left-hand side of the page, the y-axis is the weighted rate of MMDA balances. The x-axis is the growth in balances. So as we think about what's an attractive quadrant to be in, the yellow quadrant where banks were able to achieve outsized growth in balances, but at maintaining a lower overall portfolio rate, that is the most valuable place to be And those are banks that have already made that move into healthy C&I books. They've made the move into a primacy posture with their clients where they're writing the full relationship into term sheets. It's understood that that operating relationship comes to the bank. So those are the advantageous places to be. If you think about the purple quadrant, the low growth, but a high portfolio rate, that's where we're looking at banks who really had to be scrappy to retain balances and then go out and get balances and still saw overall balance declines and at a very high cost. So the important thing here is to recognize, again, where do you stand against the rest of the industry? Because it's going to inform how you can compete going forward, because it's going to reflect the levels of pressures you feel as you seek to build growth off of the foundation that you have today. All right, as we think about what does disciplined pricing look like? So there's your mix, but then how do I manage my existing portfolio to see the best possible outcome for me? So we look at our top quartile banks in terms of performance. And so this is a blend across the highest performers within our consortium. The black line is the all-in numbers for banks, and that portfolio rate you can see is materially above the blue line, which are the top quartile banks. So what you can see, and then the dotted line is the acquisition rate. So the 3 months rolling average acquisition rate. You can see from where those lines match up against each other that banks who used more pricing discipline out with their field, they were using the competitive intelligence, the market intelligence, the trend lines to delay both the repricing of their existing portfolio, but then also temper expectations and actions out in the field around what those acquisition rates could be. Notably, too, in the call out in the upper left, the balance growth also outperformed. So not only was there an ability to temper the portfolio costs, but there was an ability to go to market with a discussion around getting that full operating relationship, bringing in balances, and growing the book. So as we think about these converging disciplines, it translates into a meaningful value in terms of interest expense saved. We saw north of 50 basis points for multiple banks. That's really important to their health of their balance sheet as it stands today, and is a critical discipline to get going if you don't have it in place already.
It is also the largest. Sorry, it's also the largest needle moving component today. Every $1 billion, 1 basis point is $100,000 annuity. Getting this right, to your point, has the ability to add 1, 5, 10, 15, 50 basis points of immediate revenue to your bottom line.
And so our clients who don't know where they stand on this, give us a call. And this is a view that is now going to be introduced into our commercial deposit analyzer. So you'll actually be able to see this for yourself. If you're not a client, certainly give us a call. We're happy to help you figure out where you stand. All right, I already touched on a couple of these aspects, but in terms of how do banks outperform in this regard, and it really comes down to the items at the bottom. What level of transparency do you have throughout the organization around, pricing trends and your own pricing strategies? So is that information shared on a regular basis? Is there healthy governance in terms of that partnership between your centralized pricing teams with your field? You need to give the field flexibility, but it needs to also have some healthy guardrails and healthy challenge posture to make sure that the right decisions are being made for the bank. How are those incentives aligned? Do your folks in the field understand that deposit quality is also important and not just balance growth? And then lastly, is the organization universally focused on profitable growth? We are well past the phase of the 2023 crisis wherein banks needed to get balances at all costs. If you still have parts of your organization that are behaving that way, they need to come back to a position of profitability focus. Okay, now let's go into that last fourth area. Already started talking about it, that focus on sales force effectiveness. So what are some of the best-in-class attributes that we see across banks? First of all, the go-to-market approach that focuses on client value is incredibly important. We'll talk about that more in a moment. Aligning the incentives, just spoke about that, right? As you remix the business, do you have the right discipline in the field, and they're incented to make the shifts that you're asking them to make? In particular, you want to make sure that your incentives are aligned between your relationship managers, that primary voice of the lending need, with your treasury management specialists. So do they work hand in hand, and are they working towards a common goal, or are they inadvertently working at cross purposes? Lastly, having data-driven, accountable operating routines. Right, that's where your ability to outperform the industry is based on holding people accountable to the shifts that you're asking them to make, but then providing them the right supports with data and evidence that says, this is a successful way to go to market. Let's get comfortable with using the data in a way that gets us to the type of profitability that we're looking for. All right. Let me keep going. In terms of Salesforce effectiveness, this again speaks to that go-to-market posture. So as we think about how banks have typically traditionally gone to market, it's very much with a client-centric view where the client is at the heart, but then the relationship manager is their primary point of contact. And then the relationship manager will selectively, at their own discretion, bring in the specialists. This is an approach that has worked in the past when the lending need was sort of that primary entry point. As we think about shifting the mix towards and differentiating to win in specialty verticals and looking for more of those fee-rich, deposit-rich industries, having the RM as essentially a gatekeeper can really be an inhibitor to the type of growth that you're trying to attract. The right-hand side is a more accurate reflection of how best-in-class banks are going to market with their clients. So they're looking at the client as an equal partner, and everyone is surrounding what is the mission? Are we trying to grow the business faster and they need capital for that? Or are they trying to actually run the business better, in which case your treasury management solutions are more important to that relationship even than that lending side. So that ability to really surround the client with the right resources and then hold the client accountable to be a partner as you look to integrate complex solutions can be a really important difference in winning that relationship as a strategic advisor versus being in a position of, you know, kind of coming to them with credit offers that aren't really where their focus is. All right, the last piece of Salesforce effectiveness that is most important to focus on is accountability. So as we think about how do you drive execution, it is really about that accountability. And we talked about it a little bit with the pricing and having the right tools. So as you are remixing your business, being able to measure the effect of that, watch it as new balances are being brought on. Is the field pricing them effectively? And then are we seeing how the rest of the industry is shifting? And are we needing to make further shifts for ourselves? So having that sense of accountability that's driven by data, having the governance routines in place that ensure you have the collaborative posture that you're looking for, and then the reporting that says, are we seeing the shifts in the mix that we're looking for? Bob or Peter, anything you would add on that front?
No, I think you nailed it.
All right. So now let's turn to what does this all mean for how to accelerate your strategy. For this one, I will turn it over to, I forget, either Peter or Bob.
No, this isn't scripted at all. So when we look back at the past 2 years and really where we have focused a majority of our work with banks, both large and small as $5 billion in assets, there were really 4 big underlying themes. The first is understand what we are acquiring by market, by segment, and how does it impact our balance sheet mix? What does our expectation for operating deposits from these relationships and intentional growth really look like, and the profitability profile? The second big avenue is we have a good strategy, but we feel like we could be doing better, or we feel like we are losing out on a portion of the wallet. Is there a capability, or is there a primacy level or a profitability ratio that we are missing out on by lacking the coordination on the front end with the TM side, or with a reapproach to how we're driving our RM incentives? Finally, for those that have kind of solved both those first 2 buckets, we have this what we call optimizing the value exchange, which is really, where should we be pricing? What is the governance? What does the incentive structure look like? Again, the biggest needle moving item for those that already have a good strategy in place, but also quickly identifying low hanging fruit for pricing optimization on both standard and exception pricing from a TM standpoint. And underlying all of this is the continual reinforcement of organizational design and sales force effectiveness to ensure that we have the proper gearing out in the field. Now, there should be a bubble around all this, highlighting the ability for these all to contribute to higher levels of primacy and therefore higher levels of profitability to the bank, as well as the end balance sheet. Peter, Margarita, anything you'd like to add to that?
The only thing I would say is underneath all of this, this is a nice sort of neat story. There's actual numbers and data that make this real and can help us figure out where we are, what's going great, where our opportunities are, and how high is high. And that is, for those who've worked with us extensively in the past, you'll be very familiar with that approach. For those who haven't, all of this underlying data allows us to really quantify the art of the possible and how we do it in each of these phases.
All right, so coming back to our audience, as you think about what you've heard, what is your top strategic priority? Let's see where people's heads are at. All right, we're seeing some of the similar.
I love this part because you can tell if people were actually paying attention or just asleep at the keyboard, because everybody comes off of idle. So we appreciate the engagement.
Right. We do appreciate the engagement. All right.
There you have it.
There you have it. There you have it. Yep. This is consistent with what we're hearing from our clients, that focus on mix and total relationship value. That is the biggest needle mover over time. And I would just continue to emphasize that having the right strategy in place is going to be a huge time saver over time, because it's a long game to create that shift in mix. So certainly we're here to help. Bob or Peter, anything you would add before I wrap us up on an inspiring quote?
I want to revisit your opening quote for just a second in the context of that poll result. For everybody who's moving, who's growing, who's gotten sort of a next tier, whether that's we've just crossed 10 billion, or we're knocking on the door of LFI at 100 billion, or we're looking to become the next true national, right? That mix and relationship value piece does not look like what got you to where you are. There are real break points and transitions in what that mix looks like and what's possible as you move up the scale size. So that's something we've helped so many banks navigate. And if you're there, if you're knocking on the next level, and we would love to talk to you about that. Now you can do your end quote, Margarita.
Yeah, that's right. All right. So, bottom line, do what you can with what you have, where you are. Your heritage and history is so important and unique to you. And that has to be a critical part of informing now where do you go. So we are excited with all the engagement that we saw today. When you get this recording and materials, you'll have my contact information in that email. Please feel free to reach out. If there are any questions, throw them in the chat, but we recognize that given everyone is focused on growth strategy, it's perhaps not a public forum kind of question to get engagement. So we appreciate your time and engagement here. Unless there's anything else from Peter or Bob, I think we'll wrap up.
Thank you all.
All right. Thank you. Have a great day.